Good morning, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our strategy of the week update here for, oh gosh, what is it? July 15th, 2022. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. We're going to get into the row crops here, a little red on the board. They were positive on the day, now coming back negative. It's a kind of a sideways go nowhere Friday. We're still higher highs and higher lows there for at least for corn and soybeans in the December and the November contracts, respectively. Not a great look, though, that we're turning over where we are, and we'll get into that in just a minute. But we are still holding some bigger levels as support that have, I think, put a footing in here in the market. But as we've discussed here in the last several videos, we're kind of in the middle of nowhere with momentum and RSI indicators suggesting maybe a little bit of a range in the near term, and that seems to be kind of what's been carving out. We're going to begin with November soybeans here today. There's quite a bit to discuss here before the session ends. And looking at that daily chart, again, we're above this old cluster of highs on November beans from the $13 area, broken resistance from the start of the year, now coming down and tested as support. In the meantime, near term, we've been remaining below this 200-day moving average at 1379. Not a good look. We want to see the market get back above and stay there if we're going to consider this, a bull trend resumption. The 18-day moving average has been solid resistance on the way down. The first time at $15, the next time at 1440. It's now down to 1400. And if the market could rally back up to test that as resistance, I would feel a lot more comfortable than what we're seeing play out on the chart here today. We're getting that bearish crossover that's happening today, and by next week, we're going to see that 55-day here at 1477 below that 200 or 100-day at 1477 as well. And again, that bearish crossover might be encouraging some technical selling here on the day, as that is oftentimes a longer-term, fund indicator for a trend reversal and for, in this case, for the market to head lower. I'm not saying it will. It's just something to look out for. You can see when we crossed over from a bullish standpoint at the start of the year, that started a bull run. We're above the 18-day moving average, above the 200, and we ran up, holding that 18-day as kind of supportive. Then we came to test the 55-day, held as support. Then we came no real support at that 100-day, but we did hold it all as resistance on the way back up, and then down to test the 200-day moving average. It's all good. We've seen that chart before, and we know what we're dealing with there. On the shorter time frame, this 4-hour chart for November soybeans, there it is. We have to consider the fact that, and the idea that, off of the highs here, a 50% area around 1440 kind of almost traded. I would have liked to have seen it actually fill, but nevertheless, since then, we've had a day here of higher highs and higher lows for 2 days running. Today is inside price action for November beans. So I take back what I said earlier today. Just the December corn has made that price action. And today, for all intents and purposes, well, I'm going to move down to a 15-minute chart real quick here for November beans, has really just been sideways inside of the range. 50% retracement longs got reactions off the low initially, then failed out their 6-18 lines. Any kind of short you drew up against them also got reactions off their 50% level just slightly, but then failed out. Once we had both sides failing out inside of this range that began, we effectively just started chopping sideways. And that's, a signal for me in the near term to just start drawing up trendline, resistance, trendline support, and then expecting the market to kind of be going sideways inside of that in the near term. Now, I mentioned in my previous video here, was it yesterday or the day before, this old low-to-low extension is providing current resistance on the beans. I don't love it because we actually, we were holding other levels here on the way down. There's a 50% short off the high that held around 1420. That then went down, blew out of shorts. Then we had the same low-to-low that I have drawn up, only this was down here to intraday down to 1369. You can see how it rallied up, held its resistance area between the 50 and 6-18 line, and then went down to and through targets. At that point, you would assume and be looking for the next extension short from low to low. That got reactions there on Wednesday got a reaction, went down to a new low, then came back up and invalidated the trade. It was at that point that we were talking about the full 50% long, or what we call an ambush long, off of the lows. So from that 13.15 low up to the new highs there, we saw pullbacks that happened in early hours, kind of got a reaction, came back and tested it again. There's actually a reaction here on first test of the actual 1338 area. It moved almost 10 cents off that, but then failed out and went down to the 61.8 line. So, market is technically getting reactions from levels that we're expecting, or algorithms would be attaching themselves to. And again, this is all outside any kind of fundamental we want to talk about. This is just the pure patterned typed trading that occurs in futures and in markets. That is 50% of the equation when it comes to price action and price discovery, because there's just as much validity to market participants who are in here, unfortunately, as fund traders or as speculative traders, as there is to people who are in here as commercial entities. I know commercial entities and producers don't like hearing that, because the commodity should be worth what the commodity is worth. Well, unfortunately, part of that price discovery occurs from fund participation and speculative interests in the market. And that might be a good reason, and how we get to over $15 beans in April, May, and June, early June, when we're going into a planting season where a wall of grain is literally coming down the pipeline within 6 months. And then, of course, it also stinks to hear this, but that wall of grain is probably a good reason why we saw that selling and panic selling. As those interests start to get out, they spin the pendulum the other way, and usually we overdo it in both directions. So we probably got overdone to the upside, and now overdone to the downside. But we are flagging here in what could be considered a bear pennant, but certainly flagging for the November beans in the near term, and coming off of what was a little bit of a double bottom here this week. Certainly could be almost a test of last week's low, but having broken the 50%, the full 50% long off the lows from last week to the highs of this week, is again a big reason why I'm looking for more sideways price action in this range between 1320 to 1420 than I am potentially saying, oh, a bottom's going to form here and we're going to go back up, to $16 or something. That's just kind of crazy talk at this point. As much as I want it to happen, I don't see that happening without some other things changing, first. And one of those things changing is, of course, getting into an actual weather market for soybeans. We looked at the charts in a prior video here of last year, and let's just go ahead and look at it really quickly again so that I can bring everybody up to speed with, where my head is at in terms of what soybeans in the November contract can do. Let's look at soybeans from last year in November through this time. We had a very, very aggressive trend that came into and through the end of 2020. It took us through the highs in two highs of 2021, and those highs were made in the April to May to June timeframe. We then kind of went sideways in November beans through August before having one more push lower down to test $12. We bottomed and had a harvest low in November, and of course you had to look to February, March, and May contracts. January, March, and May contracts for the beans here to see them, go to new all-time highs. Well, all-time, but contract highs and certainly seasonal highs. Not all-time highs just yet, right? But with that being said, that doesn't mean, that there isn't validity to the argument that here in June or July, kind of somewhere in the chart, there isn't, enough for $2 to $2.50 of higher, because, from early July through the end of July here, there's certainly a substantial rally from the low 13s or even the high 12s up to above 14. And again, another rally here, in early August there from 13 back up to almost 14. So given that this year's a lot more volatile, and there's the market's been moving 60 cents up and down just in the last couple days, there's certainly the ability for the market to trade back up towards, within 20 to 30% of its highs, like it did last year. And that's what I'm getting at, right? Okay, so maybe we're formulating some kind of low in the charts like we did June through July here last year. Timing-wise, it's a little different, but the same concept or idea. We definitely have had these periods of multi-day inside kind of sideways, almost bear flags that then end up ripping out to the upside when something happens. But in my opinion, last year they were, led more by corn at this time of year, which we'll get into in a second. But I don't think that there's any, a lack of ability for what is now, November 22. There we go. Beans here to trade very similarly to last year. Head up towards $14.50 to $15, come back down, then go back up, and then maybe have another push down to 12, like we did last year, into a harvest low in November before then rocketing higher. If we're going to do what we did last year, that's what this chart's going to look like. And so far, we're following that pretty closely. Now, we can't discount the idea that we'll go just down to $12 or $11 just here now. If we start to break below 13 at this point, we're falling back into that range for this contract. That could open the door down towards 1150, but it's too soon to say that. We've clearly fallen off a cliff. We found a floor of some capacity. The market was able to rally almost $1.50 off that floor, and right now we just have a pullback that's retested those lows and has had some inside price action in the last 24 hours. Into next week, if we gap lower and head lower, that'll definitely be some kind of tell for us. But for the time being, getting a move back above the 200-day moving average, a little bit of a reversion to the mean, and at least testing towards 1450 to 1460, maybe even as high as that 55 and 100-day moving average crossover, probably not out of the picture just for me. And is a reason why, this last week, actually starting last week on this dip and certainly into today, I was looking at some option strategies that have finite risk, okay? I'm not saying, and again, futures involve risk, and everything I'm talking about here is not a direct trade recommendation, but just my own opinion. These option strategies are a way to minimize your risk in an otherwise volatile market, right? Because, when you consider that, okay, if you want to buy soybeans here, at 1334, or you're a seller up at 1350, just on the range of the day, whatever, right? You still have to risk 20 cents plus to get it above like the recent high, or 20 cents now down to the recent low. So, hey Dan, I want to be a buyer in soybeans. 1334 looks great. It's kind of a triple bottom in the day. I don't love that, but the idea is that support's holding. Maybe a little bit of a trend line coming up here from over the last week is forming. We think we're in a range. So for some reason, this becomes a buy for you. Stops aren't really safe until below 1316, that low from Wednesday, in my opinion, because we could just go down to 1320 and come right back up inside the range we've been in. And the point I'm making here is from a 1360 low up to a 1365 high. That's 50 cents. We've been, down, back up, and now back down partially. So that is 1, 2, 3, 4, 5 times in just the last 3 days we have transversed a 50-cent range in the soybeans. It is very hard to trade a futures contracts here with stops and not just get ticked out and not be hunted. So a way we can get around that is with a call or a put or a call spread or a put spread. Finite risk that has just time value and time on it that, okay, if we want to place a trade here for the market to go higher, there's a couple strikes and a couple levels I'd be interested in. First off, the 1380 is the first one where I'd want to own a potential call. Also, $13 puts, probably not a bad proposition. They're going for 58 cents in November. You can cut that down. Wow. Okay, that is incredibly expensive. Like, that's just almost mind-numbingly expensive. But a $13, $12 put spread right now, that is 34 cents out of the money, right? Costs you 58.5 cents out of pocket to buy that $13 put. 22.5 cents to sell the $12 put. You got a dollar spread on the market for, what is that, 35 cents? So that's at least 3-to-1 risk-reward ratio, finite risk to bet on the downside in beans. Now, I've been advocating and kind of been more on the long side of the equation. The most aggressive I was looking at was buying the 1380 put, okay, or call, excuse me, that goes for 59 cents here. And again, a 1480 call, get that dollar spread on here. Now that's going for 26 cents because you're going to bring in 32 cents. So you can see that the call spread or the calls here, because we just sold off 20 cents from highs of the morning, that 1480 calls bringing in a little bit more than that $12 call in a similar dollar spread that is pretty close to, well, I guess the 1380 call, 1480 call spread is about 50 cents out of the money, um, but we only have to get back to the highs of the week for it to be in the money, and the highs of last week for you to be 100% profitable on it, right? So the ability for this market to rally back up to 1480 is just a couple days at this point. The ability for the market to sell off below $13 and go to $12 is just a couple days away. So I see while we're in this sideways price action, those spreads have lost a little bit of value on either side, so that we're basically placing a trade with the idea that we'll go outside of that range at some point, and you just kind of pick a side that you think it'll go. I'm a little more bullish still because not to say that I think we'll go to contract highs, but I do think we are putting in lows that will then drag us a little bit higher here into next week, and certainly at least period of price discovery higher. And corn going higher highs and higher lows, which we'll look at in a minute, is helping with that. So again, the other another strategy I was kind of looking at was a 1420, 1520 call spread. That's where now you're getting down to more the 4-to-1, 5-to-1 risk reward ratio. 1420 call is going for 46 and some odd cents. You can sell a 1520 for 25. That's bringing that cost down, to just under 22 cents, or let's just call it 22, 23 cents to make a dollar. Now you're in that 5-to-1 to 4-to-1 risk reward ratio that I like and look for in a call spread or an option trade strategy. But we're a little further. At the highs of the day, we were 80 cents out of the money. Right now we are, 70 cents out of the money. Right now we are 90 cents out of the money on it. But again, we are just a couple days away from going above 420 in the velocity that this market's been moving and the volatility we've seen. Okay, so moral of the story is I wouldn't be trading futures per se because of the choppy nature of this market. I'm minimizing risk right now by looking at call and put spreads and strategies like that can help with that in that regard. I'm also, I've also been the type that has looked at and used short dated options to help offset risk. So let's say you do want to get long a future or short futures in this range. I'm going to the August on November options. There's 7 days left. So a week from today, these go off. We could be looking at buying a future. Let's just say you get filled at 1334 for 20 cents of risk, rather than putting that stop down at 1320. You can buy the 1330 put for 22 cents. So in lieu, I would suggest to anyone trading these right now, in lieu of putting an actual stop down there, buy that at the money put. Yeah, I'm pissing 22 cents away potentially because if the market goes higher, you got to go through highs of the day to start making it back. But that's okay to me. That's a sacrifice I'd be willing to make, to know that if we go down to 1320, I don't have to watch this thing through 15 cents of downside losses. And by the way, if we go down to 1320 or $13 and you decide you still want to be long, you can at least buy back that short or sell out of that long put for hopefully some form of a gain. Of course, the 7 days left, that 22 cents is going to evaporate quickly, but it does give you protection at basically below the lows of the day right now for a 1330 put at 22 cents for the next week. If we're below that area into next week, okay, you're out your 22 cents you spent on the trade. You're out that slight difference, that 4 cents on the futures. But to me, that makes more sense than putting an actual stop in the market down 22 cents below us in this volatility, because we could easily go hunt that stop, turn, and go higher. And if we do, and you have the put on and a future, then all of a sudden you've got sorry, here I'll bring up those puts. Then you've got a strategy on now that is a little more aggressive. Now, these options are pretty expensive for 1 week. If you're looking for upside, or downside, you could do a put spread here pretty nicely. Want to take a trade that is looking for a move lower and below $13 right now. I mean, you could, before next week, for 10 cents right now, just buying the $13 put seems like 10 to 11 cents doesn't seem like a bad proposition. You only have to go to $12.90 for it to be in the money, and we got 7 days to get there. If this thing breaks down into next week, that $13 put that goes off next week will, if we gap lower, that thing could gap deep in the money if we go lower. Now on the other side of that coin is I think the 1350 call here for about 18 cents is interesting, but I would like to cheapen that up a little bit. And we can cheapen that up substantially by selling a $14 call and bringing in 5 cents. Again, this goes off next week. So if we think we're going to be above today's high throughout next week through next Friday, the 13.50 $14 call spread, it's 50 cents wide. You could get that done for about 13 cents right now. So again, there's that 4 to 5 to 1 risk reward ratio only for the next 7 days to put a trade on that is, with the idea that we're going to go through highs of today. But we, also kind of acknowledging that going through the $14 level is probably going to be somewhat of a tough nut to crack. And if we do, will we get to 14.20 or 14.40? Maybe. But I think that 50 cents of upside above today's highs is manageable over the next 7 days. And hey, maybe the idea I leave everybody with is buying the 1340 or 1350 $14 call spread for 12 cents, and then buying a $13 put for 11 or whatever 10. You're spending effectively 22 cents to say that I think we'll be below 13 or above 1350 by next Friday. And so long as it does, you got a pretty good proposition to be able to make all that money back. You'd have to go below 1280 to make it all back to the downside. And you'd have to go above, 1360 to make it all back, start to make it back to the upside. But, going effectively saying that I think sometime next week we're going to be 60 cents above or below where we are right now is probably pretty accurate, right? And you don't need to even have a bias at this point because you're going to have a position on for a directional move in either way. Okay, so that was a lot on the beans. I kind of wanted to give my ideas on how to trade a choppy market that is pretty volatile. Plenty of ideas there, whether you're going long a future and using a short-dated option or short-term option, I should say, to offset it. Actually, a short-dated, short-term option, right? 7 days, those August on Novembers. You could just look at outright call and put spreads as well. Of course, that strategy of buying a 1350 call, selling the $14 call on the August and November options, as well as buying a $13 put. That's what I'm going to write down, and I want to come back to next week and just see kind of how it did. So unless we're sitting right where we're at right now, you're probably going to have an opportunity to make something on either side of that coin there. But an idea, that you don't necessarily have to have a directional opinion in these markets to place a trade that is going to make you something no matter what the market does, right? That's a strategy. The one through next Friday, it's a strategy that says, I think we're just going to move, a dollar in either direction by next Friday, and you're gonna make something of it. Okay, November. I'm sorry, what am I talking about? December corn. Trading 5.98. I don't love that we're really struggling to get above that $6 figure, but we are, the 620 and 628 19-day and 200-day moving averages are above us. We're in no man's land in that daily stochastic RSI, so, again, suggestive of, I think, some more sideways price action. The corn has been a little bit more technical off of its lows. It held that 590 area as support, the ambush long we talked about, and we'll look at that in a minute. That was a valid, futures buying opportunity in my opinion, but it's going to be tough to have a stop anywhere but, basically at 585 to 580 at this point. But again, there's options, August on December, that we can utilize to offset some of that risk into next week and go home, with being able to sleep at night. 695, 55-day moving average, and 685 for the 100-day. Gonna probably get a bearish crossover on those, but probably won't happen until Tuesday next week. The market's already anticipating that kind of thing happening. So again, we have kind of a sideways struggle here between the 560 and 660 area, a dollar-wide range for December corn to be able to trade through. Just like the November beans, December corn came back and tested that old resistance we broke out of last year as support. Kind of got a trend line here coming through the lows. But boy, would I like to see this market get back above that 200-day moving average and at least maybe testing, certainly break above that 18-day moving average before I turn a little bit more bullish and more confident in being a bull in the corn market at this time. But We'll look at weather in just a second. There's a good reason why I think today's a little heavy, and certainly why we're at the prices we are. Because if we've blown out weather premiums and we're trading the current weather we're seeing, I know there's a lot of people who want to say they didn't get much rain and this, that, and the other, but a lot of the indicators say that over the last week, much of the Midwest got an inch to 2 or 3 inches of rain. Really, more in that 0 to 1 inch of rain for the majority of places, but some places getting a little bit more of a drench. That's tough to reconcile, particularly with the storm fronts that we're seeing go through today. The other side of that coin with weather, which again we'll get to, it's getting really cool at night. So while it might get that hotter up to pushing in the 90s during the day for much of the Corn Belt, there's definitely some places south that are pushing in the hundreds, and you guys, that's an exception to this rule. But I know at least in my area of Illinois, certainly west of here through Iowa, all the places I see that are getting into the 90s or high 80s and some nice heat during the day, it's really cooling off at night still. That's certainly sucking a lot of humidity out of the air. It's giving us the chance of these storm fronts to come through and pop up thunderstorms. But the moral of the story is that if that 90 heat were sticking around overnight, then I think we got that real damaging heat. Now, a week from now, next week, the 2 weeks out, not speaking to what we could see, I'm just saying the last week or so was a lot more mild than what I was anticipating from watching weather over the prior week. That's all. I'll leave it at that, and we'll go over the charts in a second. December corn still has open gaps at 673 and 730. Talked about how, I kind of think December corn should catch a little bid up towards that 666 to 673 area. That would at least test the full 50% short off the highs, another level that didn't quite get there, kind of like the beans. But something that did happen on that December corn, which we've looked at, that full 50% contract low to high, traded to the tick. We closed an open gap we had left from the start of the year. So the chart is all cleaned up with just open gaps above us. At some point, I do think we'll be a magnet up to there. I was really hoping the weather over the next 2 weeks would be it. But obviously today, I think we're taking some risk off the table. And the trade is generally concerned because of what we've seen. So let's run over the last week of price action. We did this before in my other videos, but I think it's important to look at it again. Corn, off the high, we held a little, micro 50% short. We started, stair stepping lower from high to low here. Bit of a front run, but you saw the bid catch up. We found the 645 area as resistance. Again, a little bit of a front run here at 644 3/4. But what is a half a penny between friends? That went from resistance down to targets here. You can see at 627 to fill that gap early in the week and early in trade. The next in the series would have been from that entry high down to those target lows. We're just stair stepping lower on corn all week. Again, came up, a little bit of a front run there. Off the low, we gapped up in the overnight, little front run, maybe a little bit of a second test there into the day, and then the market sold off. Down to its next in the series target at 621. We then kind of began maybe arguably extension shorts. Same anchor, new low of that extension here did in fact kind of break. So good reason why I think we're finding support at 695, and I'll get to this in a second. But low to high here, basically another 50% pullback on the day. However, we were talking more about the stair stepping this market's done. So the next in the series, 2 steps forward, 2 steps down, 1 step up. Again, a little bit of a front run. Let's make the case here that we did it again and again. Take off the old one. Anyway, the thing is we're doing 2 steps down, 1 step back, right? 2 steps down represents the 100% move. 1 step back represents a 50% retracement. There was one right there, then one right there. And then from this high to low, you could call this the full 50, or we might have gone down into an extended short. Either way, the idea remains the same. Let me clean these up and remove some of them. Either way, the idea remains the same. On Wednesday's price action, we came up and broke the 618 lines. Mentioned how I wanted to see us break above the $6 figure, and maybe we were holding a low to low from here. Either way, all 3 of these, doesn't matter how you drew that next in the series of this leg down, right? So this leg down had a series of shorts that all three, no matter which way you could argue they were, broke when we went back above $6. I had a strategy of the day. We were covering this throughout this week. That broke. And once that broke, the next in the series is actually what we refer to as an ambush long, a reversal setup. So from entry low to target high then, or to the next high right after, we expected a pullback, a potential pullback down into the 591 area. Market gave us that pullback, 2 steps forward, 1 step back. Now we're heading in a trend higher off the lows. Doesn't mean we're going to go and blow out and go to $7 and what have you. It just means that we broke the series of algorithms that were selling. The technical sellers on the way down have now reversed, and now they're technical buyers on the way up. Period of price discovery lower has ended. There's now a period of price discovery higher. Can take us as high as they want to go if the market goes. This is trading without a bias. This is looking at the footprints in the sand, and this is trying to figure out what the market is doing, reading the hints the market's giving us, and finding out and guessing where that next footprint's going to be. We're tracking prey here, not throwing darts at a board, not trying to speculate on what the market could do. We're reading between the lines and trying to figure that out, okay? There's a big difference in my mentality of how I look at the market that way. Some people might say, well, Dan, this is all after the fact. Well, sort of. This ambush long was not after the fact. We talked about this 590 to 580 support area that did hold when we finally broke above $6. It gave us a pullback, and I hope some people were buyers down here. Today's price action could be just another, kind of technical break because we went to new highs. Moral of the story is this pullback has pretty much held supportive areas. It is a Friday, so we're going into doldrums into the weekend. But if we see this market take back off, get above $6, and certainly close at or closer to highs, that is a lot more constructive than price action than we've seen, earlier in this week. Again, there's a full 50% short, though, from the high to the low that we need to consider. So resistance up to the 617 to 620 to call it 630 area is potentially there. But we could just go through those levels and be on our way up to the much larger levels that we're talking about. I would not discount the volatility in either direction for corn here today. Okay, so real quickly here, let's look at some option strategies for corn that I was looking at today. I'm still liking the 620 strike for upside ownership. In this case, I was selling 720 calls against it, maybe selling the 750 call against it. 620 call is going for 45 cents, pretty expensive, but 133 days left, okay. But it is also only 20 cents out of the money. So we, just go back to a highs of the week, you're in the money by 30 cents and almost made back that entire cost. However, I was selling 720 calls against it. That strategy is going for about 24, 25 cents. It's a dollar-wide strategy. You're getting 4-to-1 risk-reward ratio on it. That's where I like to find that 5-to-1 to 4-to-1 risk-reward ratio on call spreads or put spreads. Anytime I do a vertical strategy in options, that's the risk-reward ratio I look for, particularly when you've got when you're closing in on that 100-day mark. There's enough time in the clock to reach your objective, but also you're not that far out of the money. A little riskier here, but you could turn around and sell 530 to 510 puts and bring in premium to pay for that type of strategy. That you need to know what you're doing with a short put. But if you said to yourself, I wouldn't mind being long a future down at 510 or 520, and you've got deep enough pockets, that can actually become a way of paying for that call spread. And then if we do go lower, you're okay taking the futures contract. And by the way, the break even on this would, be down around $5. So you've got plenty of time to work out of that position if you want by selling a future to offset all the risk in that short put. But I don't really advocate, and certainly not going to advocate in this video for doing that. That's only a strategy that I would work with a broker like myself, and again, advocating for opening an account with me and working with me is because I know how to look out for those types of things and manage the risk on that type of exposure, right? You can't fall asleep at the wheel. If you're ever short a naked option, that is a way of losing an infinite amount of money in theory, while having limited upside. But using them strategically to help pay for other strategies, where there is a game plan for how to work with it, that's a different story. All right, so let's say we think corn's going down and going lower. 575 threshold is not that bad. Let's look at those August, 1 week out, August on December options. The 575 calls are going for 6 cents. That means basically 570 is your break even here. That's 30 cents out of the money for the next week. If corn drops like it did last week and has any kind of 40 or 50 cent day, you're only a couple days away from being in the money. The other side of that coin, too, is look at what you can get through next week. If we think we're getting above 620, it's only costing you 9 cents here to buy that call outright for the next week. I don't hate that idea, but I would turn around and say maybe it makes more sense to turn this into a, check this out, 605 or 610 call. Let's go with the 610 call. Highs of the day. Cost you 12 cents to get into that option. I would turn around and cheapen that up. It's kind of tough to cheapen that up. I might just work with that outright. Of course, getting long a future here around $6. Pick a place to put a stop in for the next week for 8 cents, or actually I'd maybe go for 12 cents here at 590. You got 10 cents of risk between your long futures at $6, which is where we're trading now. Risk is down to 590, so that's 10 cents a loss you could eat there if this option gets triggered. And for another 12 cents, you have that privilege. So that's effectively a 22-cent stop to buy a future here for the next week. And likewise, you go short a future at $6, you can do the same thing with 610 calls, right? For 22 cents, again, that would be, you need to move above the highs of the day and below lows of the week here to trigger either one of those stops. But again, get into a synthetic call or put here in this type of sideways price action. If you're going to risk 20 cents over the next week, that way you can't get ticked out on a market that is, in a period of price discovery right now. Not as volatile as the beans. I think in the corn, I just like the outright call spreads right now for long dated or full dated December because I think that there's some, way more than enough time in 133 days to get there. And also, if weather markets pick up here and we actually do see things get hotter and drier, that could change things. Speaking of hotter and drier, those maximum temperature forecasts for the next week here, again, pretty warm, getting up in the high 90s and hundreds for most of the Midwest. The only caveat here with these high during the day heat units is that in the nighttime, they're saying we're going to get down still to the, below 80 and into the 70s in many places and even in the 60s. All this blue is 60 degrees over that same period. So we're going to see, 20, 30 degree temperature swings between night and day. That's, in my opinion, that isn't as destructive, as these weather markets appear, right? That's all I'm getting at, is that if we're still going to get down into the 60s overnight, those heat units during the day might be more beneficial than hurt. Definitely some fronts coming through and cooling off in the night is helping build these up in Canada and what have you. And of course you see this kind of swirling air mass that is hovering over, which is usually what forms a giant heat dome. So if it gets hot and dry and we stop getting that moisture out of Canada and these low temperatures overnight, that's what forms that heat dome. Right now, it's just bringing that moist air off of, some pulling some out of the Gulf up and through the west. This is all would be at high altitude, and then the cooling off at night is bringing those fronts back down. Moral of the story, though, is we're still getting storm fronts coming through the Midwest, and you can see that cloud cover berm. So nothing really building up, but this storm itself only built up out here over Montana and Idaho. You can see a little bit of a buildup here. If this rotates over and comes through the Dakotas and through Iowa, what have you, we'll have another front coming through. Again, we've seen these, the 6 to 10 day precipitation outlook is still for below normal precipitation, but look at this near normal in places where it's the hottest. Kind of an interesting dynamic going on there. 8 to 14 day, still below to near normal. This is a lot better, though, precipitation outlook than we had last week that caused a bit of the rally I think we saw. And of course, the 6 to 10 day temperature outlooks, all above normal and pretty hot. But is it that dry? That's the question that we have to be asked here. It looks to me as if through parts of Nebraska, certainly Iowa, the I states here, we've gotten between 0 to an inch of rain on average, maybe pushing up to 2, and in some places you can see 3 to 4 here for some swaths around the Mississippi um, over the last week. This is 1 week worth of actual precipitation that has dropped across the Midwest. Still not great. You can see patches in Indiana that got no rain. Even it's still very parsed out and broken up. But I think that, hey, over the last week, seeing some rain has fallen is probably what's keeping these markets a little, you know, a little hit at this time. All right. Wow, I just showed you all that on the small maps. Did I? No, I showed it on the big one. Good. All right, let's go over a couple other charts here today. Some of the outside markets that we actively watch. Let's just start with like the S&P 500 because everyone's talking recession concerns. We're certainly, I think, putting in a little of a bear flag down here. I'm watching this resistance at 39.22, halfway back short for the month. That would complete, 1, 2, 3, 4, 5, 6, 7, 3, 7, and 11 swings are what I look for corrective structures. That would complete a corrective structure down into the full 50% retracement from 2180 up to our Black Monday kind of COVID lows all the way up to 4,800 new all-time high. That would be a 50% retracement down to the 3494 area, 3509. We're splitting hairs at that point, but this would be the next in the series short on the way down for the S&P. We'll see what happens. Kind of bull flag or bear flag in here in the near term. We had 618 line break after 618 line break inside of a range. I still think we're kind of doing that. I don't know if we're going to push above 3,800, certainly above 4,000. Something to look out for in the near term. But we're not an equity indices, or I'm not an equity trader, but that's my best guess in those equity indices. Crude oil had a nice recovery, up $8 off of its recent low, but now into its next in the series short here. So that's a daily time frame. Let's look at the 4-hour time frame, show you how we got here. Coming off of this 123 high, we had a 50% short. Traded from 123 high down to the 101 low, 112 figure held, went down to its 96.9 target. Next in the series from entry high to target low, we're just stair-stepping lower on the crude now. 114 down to 94, traded at 104, went down to their 90.48 targets. Next in the series, drawn from entry high to target low. We've now traded into, and today might be the day to sell crude. Certainly with stops or with risk above 100, I think that crude probably is heading down to 87. That would take the market down in 3 waves, A, B, and then a C wave down to the 86 100% extension and a test of the 61.8 lines of the whole swing from 62 up to 103. That seems like a very good place for the next crude support to be. It's also, when you take a step back to the daily time frame, right where, there we go, trend line comes through this chart right into that 86 area. So be interested to see, but I think crude's got a little bit more downside before it finds possibly yet another low. But we'll see if we push above 100. There's some other levels in here that we could be considering, but that's one that, at least for the time being, I'm keeping a close eye on. Man, that really wraps up the day for me. I guess feeder cattle here had a little bit of a false breakout, in my opinion, of a head and shoulders pattern. You had a neckline here, left shoulder, right shoulder, head, blew through that neckline, could not get up there to fill that open gap at the 82 area in that August feeder. Kind of a weird gaps to leave open up in that 82 and 81 area. But nevertheless, the market did trade a 50% long at 169 to its 180 target. Next in the series from that 169 low up to the highs, 175 to 174 is our next in the series support that we are coming straight down into here. So it's going to be interesting to see if they hold this old broken resistance that we have in the chart from last month as support, as well as this next in the series long. If we do, upside targets from there are going to push us up towards the 83.50 area. That would fill these 2 open gaps, one here at 82.60 and one right here at 81.08 that we have in the chart. You can see them Let me zoom in on them here. You can see one right here and one right here that we've left open. I'd like to get those cleaned up on that August feeder. But then does the market top out? Because over the last week, we basically saw August feeders rally, right, in the face of falling corn prices, which does nothing to change the dynamic of how corn is, or I'm sorry, of packer or on feed margins. And live cattle really has gone a whole lot of nowhere. Did not see the follow through of the 137 to 138 figure. They would need to go higher to fill their gap at 140. Absolutely no follow through there. And, live cattle have been in a little bit more of a range bound price action. We talked about 618 line break here at 137.80, another 618 line break here. And actually, both of these, I should be making these once I see that break. I usually make these purple just so it becomes a little clearer that we're looking at two broken levels, not ones that I would try to trade or position off of per se. But I do like to acknowledge the fact that, hey, they're the reason that we are going sideways in this wedge. Break, came back down, no ambush long, broke again, went back up to test it, coming back down to test it. But like the feeders, now the live cattle has rolled over, making series of lower lows and lower highs here. This is the daily chart we're looking at. Here's your 4-hour chart. Moral of the story is I think we're heading back down to 132 and have run the risk of breaking below it. And if the feeders are being leaders here to the downside, also do that, you're probably going to see your fats follow through. More demand destruction heading into a recession, and yada, yada, yada. So with that being said, thank you for joining me today for this Strategy of the Week webinar. Remember, do sign up for either the free Zaner Daily newsletter in the comment section and the information section of this video, or sign up to join me every Thursday at 2 p.m. Today was pushed back by a day because of some scheduling conflicts. Decided to do this as a live instead of just the closed webinar, but do sign up because this webinar or this video won't be available publicly here on Facebook anymore. I will be doing shorter Strategy of the Day videos, but this weekly webinar where we cover a lot more in depth, talk about more actual trading strategies and everything. Sign up for it with that link in the comment section or the information section here. It's totally free. And of course, I will send out a recording of the video of the webinar as well if you can't attend that live session every Thursday at 2 p.m. Central. Give me a call, 312-277-0110 to discuss the markets further. If you have any questions about some of the strategies and ideas I proposed here today or want to discover how you can turn them into actual trading strategies for you, Daniel Hussey Jr. on Twitter, DNSOTD here on Facebook, or shoot me an email, dhussey@zaner.com. Have a great day, everybody. Have a better weekend, and we will be back with you as price action develops. Take care, everyone.